we're now going to talk about the markets and a lot of red on the screen as we've been discussing here this week. Joining me right now is Brian Voth. Hey, Brian, how's it going?
Good. How are you, Shaun?
Doing great, man. Doing great. Okay. It has been a really tough week. Now, some of this has to do with the fact that we're concerned about the coronavirus, but maybe some demand destruction in some of these commodities. As you look at things right now from 100,000 feet, how do you break down what is going on here?
A lot of emotional panic selling is probably the one way to sum this entire situation up right now. And that's afflicted everything, commodities, it's afflicted the stock market, you're seeing it in the currencies, you're seeing it in the energies. It is a broad-based panic sell-off. And I think I saw in a headline this morning that we have now officially entered into a bear market, which is, I think, a 20% drop in price. Whether this is a really extreme correction and we bounce back or not, hard to say. But from the stock side, and I'm kind of diverting a little bit from the grain side, but from the stock market side, obviously we've been going straight up for, let's call it, pretty much a decade. And when an average bull market lasts 6 to 7 years, we've been so overdue for a correction or a bear market. This might have been the catalyst to get this whole thing kickstarted. Mm-hmm. But even then, it's all panic and fear selling and everything like that right now. But you got to remember that typically that only lasts, a bear market only lasts for somewhere between 10 to 12 months, and then you resume an uptrend again. So it's starting out looking a lot like what 2008 did after the financial collapse. The difference here, though, that I'm looking at is you've got the stock market that is making all-time highs in the beginning of 2020, and unlike 2008, the grain markets are obviously way off of those 2008 highs or 2012 highs, whichever one you want to look at. So it's a bit of a different dynamic right now, and that's where I would actually think that the downside in the grain side is going to be less than in the stock market or the energy market. I mean, right now you've got crude oil bouncing off of $31 again here this morning, and we hit 27 on Monday morning or Sunday night, and that was the lowest price since that spike down in 2016. So the energies are like bouncing off the floor here. Commodities, I'm not going to say we're bouncing off the floors at this point yet, but we're kind of on the very lower end of the last 5 years. And yes, right now it's a panic and everybody's pulling money out of everything, but it almost looks like grains could end up being a benefactor of a stock market crash and sell-off because they're already at what I would call bargain prices. And if that flow of money starts going into them, you may see this weird thing of the stock market continue to drop, but actually grain prices finding a bottom here.
So is that sort of like the mentality of what people think about, how they think about gold, where like a flight to safety is putting money in gold? As people start to get their mutual fund statements and they get they get shook out of the equity market, so to speak, do we start to see more investment flow into the commodities? Is that what you're saying?
Yeah, like this entire thing revolves around the flow of money, and right now it has just been a mass exodus of money out, and it's not necessarily going into anything, one particular item. Gold is one. The U.S. dollar is often another one that you see, which is also interesting when you look at the U.S. dollar chart here from the last 2 weeks. I mean, the U.S. dollar was trading way up there middle of February and absolutely collapsed even down till Monday morning. And now, what are we today? Thursday. We're almost right back in 4 days to those February highs, and it's just a huge move back up today. So whether this is the stimulus package that Trump announced or whatever it is, clearly the U.S. dollar side is very comfortable with what's happening, unlike the Canadian dollar, which has still continued to drop. And so same thing, like we're getting closer to those 2016 lows on the Canadian dollar now, still 4 cents away, roughly speaking. But Canadian dollar not finding a whole lot of, faith in the Canadian stimulus package. Although, even just as we're talking now, the Canadian dollar has been down 25 points this morning or whatever, and now it's turned positive. Like now we're up 10 points. So you get these emotional things and you get these markets spike down and the panic selling, and you run out of sellers at a certain point. And that's what I think you're going to find particularly on the energy side because of where we dropped to, and on the grain side. Like I said, the stock market has a lot of room to free fall, but it's just a different situation now than it was 12 years ago in the last crash.
Yeah. Well, I remember before this drop happened, I remember listening to Bloomberg Radio, and there was an analyst on there talking about how the key thing to watch here was a change in sentiment. It doesn't take a lot of deaths. He wasn't watching cases or deaths. What he was watching was sentiment. And once fear starts to take over, look out. And then that's exactly how it played out. Now, that sentiment has worked against us here if you were long this board. But at some point, that sentiment will reverse, which will definitely, as some of what you're alluding to, that's that positive sentiment. And, hey, we're through this. That's going to work in favor of commodities.
Right. And the one thing to think about on the commodity side is we've been overproducing since 2013. So after 2012, well, even back up before that, you had the Russian drought in 2010, you had the South American drought in 2011, you had the U.S. drought in 2012. Globally, supplies of all grains were quite low, and prices obviously responded accordingly and were way up through that time frame. And what do high prices do? Well, it encourages production, and farmers respond to that in a big way. And from 2013 on, we've had these massive production years, and demand does not respond as accordingly when you've got these massive gluts of production. It takes a long time to chew through that. And so what we've seen over the last 5-8 years is this buildup of global stocks. Now, prices have come down and down and down slowly, obviously in different places. And lower prices is supposed to discourage production. And that may end up be what you see happen this year with prices down where they are. Of course, we're on South America pulling off a record soybean crop right now. They've obviously been big benefactors of the trade war with China coming in and buying soybeans out of there, and they've responded accordingly. But now you start seeing, like Argentina, for example, putting on export taxes, and that's a discouragement to production, and that's really what we need to see. I mean, everything you want to talk about the grain markets, everything in these prices is either to encourage or discourage production. Yeah. And high prices encourage production and they discourage demand. Low prices do the opposite. Obviously, low prices discourage production and they encourage demand. So there too, there's going to be countries that are going to get a heck of a deal on buying commodities here when this dust all settles.
So what are
commodities are down?
Yeah. So what are some of those things that producers need to be thinking about as they, at this point in time? Like, I often think about, hey, remember, you're hedging the board, you're not trading the board. Don't be long the commodity and be long on paper. That's setting yourself for economic failure if it all goes against you. Because so, what are some of those other things that you think about that are good sort of principles to abide by in these volatile times?
I know I always sound like a broken record talking about it, but you have to know your costs, especially this becomes so much more important when margins are tight. You have to know your costs because that tells you right there what is actually a good price or not a good price for your farm. It has nothing to do with what your neighbors or nothing to do with what the elevator is telling you that you should be doing. You need to know those numbers so you can decide when there is an opportunity, do I take this or don't I? And realize that those opportunities to price, clarify that, the good opportunities to price are few and far between in an oversupplied market. You're always going to get price fluctuations and, just look at the wheat market since fall. We hit 10-year lows at the beginning of September, and elevators were telling people, oh, you should, put in $6 targets. Our price is $5.65. Put in $6 targets and we'll pick them off. And it's a good time to be pricing. And we're looking at this like, Minneapolis futures are hitting 10-year lows. Why would you be pricing right now? So we left that alone. And literally 3 weeks later, we had rallied 75 cents a bushel. And so, you'd have to know what your point is for a good price versus bad price. The other biggest thing is keep the emotion out of it. Emotional marketing makes for really bad decisions. And you get that whole, which you're going to find right now is the whole, screw it, I'm done. I'm pitching everything because these markets have been red for 3 weeks straight and I'm stressed out and I'm tired of looking at it. I'm just selling everything and walking away kind of thing. Like what's left in the bin or whatever. And that is, it's kind of funny. It's going to sound funny saying this, but to me, that's a barometer for when the bottom is near. When farms panic and sell and dump everything. And that's why I jokingly ask clients all the time. And my clients are not the best ones to ask this anymore because they don't panic anymore. But I ask random farmers at trade shows too, like, hey, are you panicking about where these prices are at? And like, well, I'm getting a little concerned. I'm like, okay, well, I know there's more downside than yet. If they tell me like, oh, yeah, like I got to get rid of everything, I'm like, okay, you should do that because you're going to take one for the team. And now the markets are going to go back up.
Yeah, some people have a rule about that with the front page of major business magazines. So, if a stock had gone, just like up 500%, and it's on the front page of Business Week, good time to sell because the end is near for that run for sure. And kind of what you're talking. I think one of the other things too is, and it kind of ties into the emotional thing that you just talked about. I wrote a piece on RealAgriculture.com about tough decisions right now on hedging the dollar. And one thing not to do is see it drop from 74 to right now 72 and change, and all of a sudden change your strategy. And instead of saying, I think I should buy some dollars here because this drop was not anticipated, the thing not to do is leave that plan and that mindset and say, look at the 5-year chart and say, you know what, 68, here we come, baby. And when it hits 68, I am locking in dollars like crazy. Don't do that.
No, and you're 100% right. When you see things hitting the mainstream media, be it commodities, be it stocks, be it whatever. And last summer is a perfect example take what happened with corn futures, right? And it was starting to hit all the mainstream media outlets in June and maybe early July or whatever, with all the struggles on planting and just how wet it was and this and that. And farmers are never going to get this all in. And with how high prices had rallied, we just looked at this and we said, we need to be selling all the corn we have, because when it starts hitting that, like now this thing is going to roll over and die. And it's no different on the bottom end, actually. That's that old saying is that things are always the most bullish at the top and the most bearish at the bottom. And that's what ends up eventually turning that tide of a market is everybody's at the top, everybody's like, oh, this thing has nowhere to go but up, which is always a dangerous line to hear. And at the bottom, it's like, well, I got to get off this sinking ship or whatever. And it's like, well, the ship is sitting on the floor already of the ocean. Like you're not getting off the sinking ship at this point anymore. It's done. And again, that's what ends up turning the market. And I just always think back to, Warren Buffett, right? It's be fearful when people are greedy and be greedy when people are fearful.
Words to live by.
You want to be buying when people are trying to sell everything. And you want to be selling when everybody's trying to buy it.
Yep. No, that honestly, that is great words to live by and finish up with. And that is Brian Voth. Hey, Brian, thanks a lot.
Thanks a lot, Shaun.